Hey guys, welcome back to the channel. I am the Justified Investor. I hope you guys are having an amazing day today. Today, I got a special one for you. I'm going to be breaking down one of the most hated stocks in the stock market right now. That is Adobe. I'm going to walk you through the growth. What's the value of the company? And then whether or not I personally think it's justified to be trading where it's at. But before we get into that, I just got to say, huge shout out to you guys for my first video. You really came through, all the awesome comments, even the critiques of my video, I thought were really awesome. So, gonna try to just keep improving the video. So, hope you guys enjoy them. But we're gonna get into this one, get into Adobe here. First off, the stock price. This past year, Adobe has been destroyed. No doubt about it, down around 40% in the past year. And that's not even taking into account where it was during the lows about a month ago. It was probably closer to 45% for the year. And you might be thinking, Eden, it's only 1 year. Companies go up and down. Maybe a year is worse than the rest. It'll bounce back. Look at this 5-year chart. Yikes. Down around 70% from where it was at the highs 5 years ago. And still, that's not even including what it was a month ago. So probably closer to 75%. Yikes, that's a big number. But stock price is awesome. Cool to see it. But what do the numbers say? What's the growth? So revenue growth. Last year, around 10%. This current year, it's projected 11.5%. 2027, analysts have it around 9%, and then 2028, a little less than 9%. So, is there still growth in this company? Absolutely. And I would argue pretty good growth. So, just under double digits, high single digits, great growth. Is it growing where it was in 2021? Of course, it's not. I mean, the stock has fallen quite a bit, so you'd expect it to not be where it was at growth wise in the past. But the way I think about this is with the law of large numbers. So Adobe, this creative editing space, it's only so big, and Adobe is a huge company. So once you get so big, it's hard to keep growing at a pace that is sustainable. Eventually it will drop. I believe that's kind of happening with Adobe right now. So is growth slower? Yes, but is growth still good and projected to be good into the future? Absolutely it is. Look at the EPS. Last year, 21 or roughly. This year, 24, 2027, 27, 2028, up to 31. Look at the percentage this year. Almost 17%, 16.5% this year. EPS, 2027, 12%, then 14%. Still really solid EPS growth projected. I love to see that. That's what you want to see from your company. So nothing crazy red flag here. They're still growing quite well. Now, what's the value of the company? Just looking straight at this, very cheap. Look at the PE ratio of this company. 12. Forward P is an 8. For Adobe, you're talking about a company that's growing high single digits revenue and then double digit net income. Keep in mind, what is an average stock in the stock market doing? 15 to 20 PE on average. So we're looking at a company way below that has better projected revenue growth and double digit net income growth. I mean, that's it's very shocking. Look at the PEG ratio, 0.62. Don't quote me on this, but I'm pretty sure you could go into Adobe's long history, and I don't know if you'll ever find a PEG ratio that low. Look at what it was just a couple years ago. Look at the PE ratio, 51, forward P, 35. PEG ratio was over 2. This is a company that has gotten no respect recently. It's turned very, very cheap on just looking at the numbers. So it is what it is right now. I think it's shocking how cheap it really has become for a big brand like Adobe. Now, looking at the statement of income here on their latest quarter. Subscription up 12%, great number. Total revenue 13, great number. Gross profit 12%, still a pretty decent number. Looking at the operating expenses here, 10% up for research and development, lower than revenue, great number there. Sales and marketing, this one was a little bit higher than revenue. That's not exactly what you want to see, but given that the Adobe is pushing for getting their AI products out there, that's their, in my opinion, their big goal here is incorporating AI and getting that out there and getting market share, keeping their market share and trying to grow it with those products. So 15%, it's a little higher, but I'm not too concerned about that number. A number I am concerned about is general and administrative. Up 45%. That's a pretty high number. Think of this as your salary, your hiring. What's the company paying their employees? What's the bonuses they have? How many people are they bringing on? For that to be up 45% and revenue only up, total revenue about 13%, don't really like to see it. That really hurt the total operating expenses up 17%. If that's higher than your revenue, it does not spell good things for your operating income, which was only up 6%. And then you look at some extra taxes that are in there. I mean, net income only up 1%. Not a great number at all. But if you really deep dive into this, seeing that it was just general and administrative that hurt them mostly, it is what it is. That's something I believe the company can fix over time. Likelihood is they're going to lay off some employees. Not ideal, but that's what it takes to really get this company back to really strong growth, because the revenue is there. They're not spending crazy on sales and marketing or research. They just got to get their sales and hiring in check. And I think this company can really take off with that revenue growth continuing to come in. Now, taking a look over on the balance sheet for this company. First thing I said when I was looking at this is solid. No red flags here. Cash dropped a little bit, but a lot of that is due to buying back shares of this company, which they're doing heavy, which we'll talk about in a second. Maybe paying off some debt. They're also buying quite a few companies. If you look at their goodwill and non-intangibles assets there, those increased meaningfully. So total assets about the same. So that's good. Current liabilities, looking at it, their debt increased, but if you go down and look at their long-term liabilities, debt dropped. So likelihood is that's just long-term debt coming into short-term debt. They got to pay it off within the next year. So looking at their cash and short-term investments, I'm not too worried about that number at all. So total current liabilities went up a little bit, but if you look at it compared to total assets and how much cash they have, not really too concerned about it. But retained earnings was up pretty good. But this is what I'm super excited about. They are buying back shares like there is no tomorrow. Shares, they bought what is that? 4,500 more they added on. So that's probably where some of their cash is going. They are buying back shares. That's great news for me personally. I think if you're buying back shares, that means what are you? You're confident in the business over the long run. So, and that means they probably think their share is a lot cheaper than it really should be priced. So I love to see that. Love to see them buying back shares. Now, this is a slide I'm excited about. Personally, I don't think enough people are paying attention to this. If you don't know who this is Jensen. This is the CEO of NVIDIA. Arguably the greatest company that has ever existed. the most valuable company at a market cap today. So if there's anyone you want to listen to about AI and how that might disrupt certain things, this is the man to talk to. So what has he said this year about Adobe? Because he's had some commentary on it, looking at the NVIDIA GTC 2026, which is NVIDIA's big event. He stated that for more than 20 years, NVIDIA and Adobe have partnered to push the boundaries of design, creativity. Today, we are taking that partnership to a new level. This was in regards to their new deal they did. They were expanding their deal, broadening it out. So this is always encouraging to see the most valuable company in the world bringing on more Adobe. Now let's look at the Adobe Summit 2026, which is Adobe's big event they put on. Jensen was a guest there. I believe it was like the keynote he spoke a little bit at. So what did he say there? He said NVIDIA marketing is built on Adobe. Always encouraging to see. What else did he say? Tool use inside our company for Adobe is going to skyrocket. I believe the word skyrocket there is an incredible use of that word. So for it to skyrocket, he could have said many things there. He could have said for Adobe is going to continue. He could have said it's going to grow some, but to use the word skyrocket, that spells great things for Adobe, in my opinion. I don't think enough people are looking at that. He also stated there at the bottom, for 99.9% of creators in the world, this is going to elevate your art. So I believe this speaks to the confidence that Adobe will continue to carry their market share. 99.9% of creators in the world are going to have their art elevated. I think this is very encouraging for Adobe. I don't think that enough people are actually looking at this, seeing what the big CEOs, the commentators are saying about the company, especially someone as in the know-how as Jensen running the largest company in the world. So I think this is really important to look at, and it just spells great things for Adobe, in my personal opinion. So is it justified? Down to the big question. I believe that where Adobe is trading at right now is not justified in the slightest. If you look here at my base case, this is right around where they're projecting. This is nothing crazy. 8% revenue growth, 10% net income. Not crazy numbers. So if you look up there at the yellow for my base case, net income growing at 10% out towards 2030. Slap a 20 PE on it. That's not crazy. That's about in line with the market given where their growth is too. You're getting a 32% roughly CAGR out towards 2030. Even look at the bear case there. Say revenue only grew around 4%, which would be horrible for Adobe. Net income around 6%. Maybe they have a PE of 14 given that growth rate. You're still getting a 17% CAGR out towards 2030. It's hard not to be interested in this company. Look at the bull case. 14% net income, that would be probably around 12% revenue growth. 25 PE, I believe that's fair if you're growing there. 45% CAGR, but you also have to be cautious of the downside. So not everything is sunshine and rainbows. Wall Street believes that this company is going to get really disrupted. It's obvious in the share price. It's obvious what the PE are that is trading at that. I don't think I went over the PEG ratio, but I highlighted it back there. It's way low. I mean, they're basically pricing it for almost no growth in the future. So could they be true? It's possible. You have to keep that in mind. Personally, I do not think it will get disrupted near as much, and I personally think it will be a benefit. AI will be to their brand and to everything they got going on. but it's possible. So what I would say is do your own research, make informed decisions on your own. You guys are all adults. Run your own numbers. In no way am I telling you to buy the stock, but personally, I think it's an incredible opportunity. Clarity, I have been buying it quite aggressively the past month or two. I will continue to buy it if they continue to keep it cheap. Who knows what Wall Street's going to do tomorrow, but I think if they keep coming in, bringing in their numbers, I think it's really hard to get this company any lower, in my personal opinion. So I'm going to continue to buy it, but I'd love to see your comments. That is the end of this video. If you want me to look into another company, maybe you want me to look into a few at a time, that'd be awesome. If you have any critiques, let me know. I'm all for it. So hope you guys have a great rest of your day, and I'll see you in the next one.